What is your debt to income ratio? Why is that calculation so important? Why is the underwriter looking at that? Why do they care what percentage of your income goes to debt? Come on back as we take a deep dive into your debt to income ratio and figuring out why it is so important and where it should be. When a mortgage underwriter is taking a look at your file, they're going to analyze what's called your debt to income ratio. That's going to show us what percentage of your income is going towards paying existing debt plus that proposed new mortgage payment that we're looking at, right? We want to make sure you don't have too much income going directly towards a housing expense or too much income in general going to bills and not being able to afford gas, groceries, other good things like that. So this is an extremely important number that the underwriter looks at to see the borrower's capacity in the ability to take on additional debt and to manage payments on those debts as well. Hey there, this is Brandon Lewis with Integrity Home Mortgage. Thank you for stopping back by. We love putting on these little videos here for some quick tips and helpful info about the painful mortgage process. If you like what you've heard so far, click that subscribe button. We'd love your support there and always appreciate that. And let's get on with the main topic here, the debt to income ratio. To make it even more confusing, we look at two different debt to income ratios. There's a front end debt to income ratio and a back end debt to income ratio. What is the difference there? When we look at your back end debt ratio, that's going to factor in all debt that you have. So your car payment, credit card, student loan, anything that shows on the credit report, other obligations that you may have as well. It's also going to factor in the new proposed mortgage payment that we are trying to get you qualified for. You stay within the guidelines on this calculation, then you may qualify for the loan. That's exactly what we're looking at. Too much of your income going towards paying the bill. Your back end takes a look at all cumulative debt divided by the income, and are we setting you up for success with all your current debt at this time. Now, there is a front end ratio as well, and this is very important. Now this one's very simple. Your front end ratio is just taking a look at the new proposed mortgage payment that we're trying to get you qualified for divided by the qualifying monthly income. This one's interesting because this will tell us, are we getting in a situation of being house poor or too much of a mortgage payment, right? So when we do our front end debt to income ratio calculation, again, we're only looking at the new proposed mortgage payment divided by the income. Now the higher that number is, the more of your income that's going directly towards that housing expense. That's not necessarily where you want the majority of your income going. A lot of great financial analysts and advisors out there would tell you to keep it around 30% of your net monthly income. I personally agree. I don't think that's a bad area at all. As lenders, keep in mind, we are looking at your gross or pre-tax income when working up your qualifying number. So again, the front end debt ratio just takes a look at the housing payment compared to your current debt load, and are we going to be mortgage poor? We don't want to set you up for that. Quick recap on the front end and the back end. So if we're looking at the back end and that is too high, that back end ratio is factoring in all cumulative debt on your credit report and other obligations divided by the income. So are you just overextended, or are you in a healthy debt position? The other ratio that we're going to look at is that front end debt ratio. This one's just going to take a look at the housing payment divided by the income alone. Not going to factor in the other debt there. And this is going to look to see, are we setting you up to be mortgage poor, and you don't want to be that. Not a good situation to be living off the ramen noodles. How do we calculate this debt to income ratio? What is the actual math that we're using? What do some of the results look like in some certain mock scenarios there? And then also, where do we want our debt to income ratios to be? So let's dive into this, play with some numbers, see where ratios come in at, and are these particular ratios going to be healthy numbers or not? First, we're going to take a look at a back-end ratio. So let's say that this particular client has a $500 car payment, $75 in credit card payments, $25 in student loan payments, and we're looking to get this person qualified for a $2,500 mortgage. So we're gonna add that into the total debt load as well. So for this client, their total monthly debt load, including the new proposed mortgage payment, would be right at $3,100. So there's the debt, right? Now in this case, let's say the client has a salary of $96,000, $8,000 a month, that will be their qualifying income. Keep in mind, that is the pre-taxed gross figure that we're going to use for the qualifying purpose. Once we break down the math on the back-end ratio, we've got $3,100 in total debt divided by the $8,000 in monthly income. We come in right at a back-end ratio of 38.75. All right, that in itself is not too bad at all. We're gonna come back to that and start to discuss some limits and where we don't wanna be. All right, now real quick, same client, right? $8,000 a month in gross monthly income that we can use as qualifying income, but now we want to factor in just that front-end housing expense. This is only going to factor in the new proposed mortgage payment divided by their qualifying monthly income. So in this case, again, we're trying to get them a $2,500 mortgage. They have $8,000 a month in gross monthly income. Therefore, their debt-to-income ratio would be right at 31.25 for their front-end debt ratio. So keep that in mind. Remember this, we're going to come back to it. The client's back-end ratio, 38.75. The client's front-end ratio was 31.25. We're going to come back to those numbers here in just a few seconds. Where does your debt-to-income ratio need to be in order to qualify for a mortgage? Well, there is no one-size-fits-all answer for this particular question. So FHA loans may have a certain limit. Your conventional loans may have a different limit. Your USDA loans may have a different limit, and your VA loans will absolutely have a different limit. Again, there is no cookie-cutter one-size-fits-all, but the general rule is keep your back-end debt ratio around 43%, and that helps you to be in the healthiest area and give you the best chances of qualifying. Now, when it comes to looking at your front end compared to your back end, the key thing that you want to see there is you don't want the front end to be too close to the back end. That's going to show too much of your monthly income going to just that housing expense alone. So what happens when you need a new car? You take on some student loans, pick up that engagement ring. You know, you've got to factor in the additional debt that you're going to pick up down the road for those additional life events and those unexpected events that are going to happen as well. All right, my friends, that is the debt to income ratio, the front end and the back end. Again, all different numbers with different programs, but again, general rule is keep that back end 43% or lower, and that helps you to stay in the healthiest range, giving you the best chances to hit that qualification. If you like the info I've been sharing and want to hear great tips coming forward, please make sure you click that subscribe button, hit the bell as well. Want to make sure you get the notifications coming forward for all of our new videos and great tips coming out. Thank you for stopping by. This is Brandon with Integrity Home Mortgage, and I'll catch you on the next mortgage tip.